Welcome to the Deep Dive, the show engineered to really cut through the noise and get you straight to the insights that matter most.
Glad to be here.
This week, we're not just, watching the market from the sidelines. We're standing at what feels like a pretty critical crossroads for investors.
Yeah, absolutely. It's shaping up to be a high-stakes moment, no doubt. The market is really bracing for a truly pivotal 5 days ahead.
That's right. So our deep dive today is all about this critical inflation policy standoff that's going to define the week. We're talking June 23rd to the 27th, 2025.
And it's more than just numbers on a screen, isn't it? It's this genuine tug of war. You've got market hopes on one side and, well, the hard economic realities pushing back on the other.
Exactly. And our mission for you today is crystal clear. We're going to unpack the key data points, those earnings reports, and, crucially, what the central bankers are saying. All the things that will likely determine the market's direction.
We want to clarify those opposing viewpoints, really lay them out, so you can navigate this, let's be honest, incredibly complex landscape with more confidence.
Yeah, we'll highlight where the real tension lies, and importantly, what it all means for how you understand the market right now.
And just so you know where we're coming from, we've dug into comprehensive market analyses, the economic calendars, corporate earnings previews, basically getting the full picture.
Right, we've done the homework to distill it down for you.
Exactly, giving us, hopefully, a complete nuanced view so we can pull out the most important nuggets for you.
Okay, so let's dive into that central conflict first. This whole hope versus reality thing.
Right. It really defines everything this week. On one side, you have the market's persistent, you could almost say desperate hope for the Federal Reserve to pivot, a dovish pivot.
Which, in plain English, just means they start cutting interest rates.
Yeah, right.
That's what the market's been clamoring for.
Precisely. But pushing against that hope is the hard reality of the incoming economic data. And lately, that data increasingly points towards inflation sticking around, being persistent. So all eyes are just completely locked on Friday's release. The Core Personal Consumption Expenditures Price Index, PCE.
The Fed's favorite inflation gauge.
That's the one.
Yeah.
It's basically the ultimate decider for how the market reads the whole week.
And what I find really interesting here is how this big picture, this top-down macro story, inflation, interest rates, it's not just theoretical.
No, not at all.
It's going to get stress tested this week by the bottom-up view, the actual company earnings reports.
And we're already seeing signs of this divergence, this split between different sectors. The earnings calls this week are going to really shine a light on that.
Okay, so to understand how this unfolds, we need the roadmap, the macro data points.
Exactly. And the economic calendar isn't just random. It kind of builds step by step, creating this narrative arc that peaks, really, with that Friday PCE report.
All right, let's walk through it. Monday, June 23rd. What do we got? 9.45 a.m. Eastern.
S&P Global Flash PMIs, Purchasing Managers Indices, Manufacturing and Services.
Super important leading indicators these are. Tells you about the health of industry, services. Above 50 is expansion, below 50 contraction. Simple as that.
But the key thing here, and this is critical, is that the U.S. numbers don't happen in a vacuum. They come after releases from Germany, the Eurozone, UK, Japan, Australia.
Ah, so it's a global picture, a test of how synchronized everything is.
Precisely, a global test.
So, for you listening, what does this actually mean? Well, if the U.S. stays strong, well, everyone else falters.
That reinforces the U.S. exceptionalism idea, which sounds good, and it's usually bullish for the dollar.
But this is the catch. It could actually be a headwind for big S&P 500 multinationals, companies like, say, Nike that make a lot of money overseas.
Right. On the other hand, what if all the PMIs, including the U.S., show weakness, like a synchronized slowdown?
Okay, that sounds bad.
Well, it definitely amplifies recession fears. It puts even more pressure on the Fed to, cut rates, and you'd likely see a broad risk-off move in stocks.
Meaning investors pull back from risk, maybe favor safer defensive stocks.
Exactly.
Okay, moving on. Tuesday, June 24th, 10:00 a.m. Eastern. Consumer confidence from the Conference Board.
Yeah, this one's vital. It measures household sentiment, how people are feeling, and crucially, their plans for future spending.
And given consumer spending is like 2/3 of the whole U.S. economy?
Yeah.
Yeah, pretty important.
Hugely important. The consensus forecast is for a slight dip, down to 99.0 if it comes in weaker than that.
Oh.
It could certainly back up some pessimistic forecasts for consumer companies. You mentioned Nike reporting later. This could be an early warning sign for them, and maybe for the whole consumer discretionary sector.
A red flag for spending. Got it. Then Thursday, June 26th, 8:30 a.m. Eastern. A doubleheader.
Yeah. final Q1 GDP reading and the weekly jobless claims.
Now, GDP for Q1, that's backward looking, right? The consensus is already expecting is a slight contraction,
Yeah.
minus 0.2%.
It is backward looking, but, a significant revision, up or down, could still shift the baseline understanding of how the economy started the year.
Fair enough. But the jobless claims, those are more real time.
Much more. High frequency. A real-time indicator of the labor market's health. If we see a notable spike in claims.
That could mean the labor market is finally cooling off.
Exactly. Which is actually a necessary condition the Fed needs to see that before they'd seriously consider cutting rates. So it raises that big question. Is the job market softening enough for the Fed to act?
Without just reigniting inflation again. Tricky balance.
It's very.
And then, Friday, June 27th, 8:03 a.m. Eastern, the main event. Core PCE Price Index for May.
This is it, not just another data point. This is the Fed's official benchmark. Their target is 2% inflation. Everything hinges on this number.
All the Fed talk, the future path of rates.
Yeah.
It all comes down to this.
Pretty much. Expectations right now are actually for it to tick a bit higher. Wells Fargo, for example, sees it hitting 2.6% year over year, up from 2.5% in April.
Ooh, that's not the direction the market wants.
Definitely not. That would be a hawkish development. It signals the Fed needs to stay tough.
And you'll hear Fed officials all week, Powell included, saying they're data dependent, right?
Absolutely. They'll hedge everything.
Okay.
Basically saying, our comments are conditional on what the data shows. This PCE number is that data.
So let's play this out. Powell testifies earlier in the week, maybe sounds a bit optimistic, a bit hopeful.
Yeah.
But then Friday's PCE comes in hot, say 2.7% or even higher.
Then those earlier dovish-sounding comments, poof, gone, obsolete. The market would immediately dismiss them.
And you'd see a hawkish repricing, meaning markets suddenly expect higher rates for longer.
Instantly, you'd likely see Treasury yields spike and a sharp sell-off in anything sensitive to interest rates, especially tech stocks.
Okay, but what about the flip side? What if core PCE comes in cooler? Maybe at that 2.6% consensus, or even better, below it, like 2.5%.
Now that would pour fuel on any dovish sentiment from earlier in the week. It could potentially ignite a really powerful risk-on rally right into the end of the quarter.
Investors pile back into growth stocks, tech takes off.
Exactly. It really is the ultimate data-dependent test for the market this week.
Okay, beyond the big macro picture, we also get these crucial micro insights, right, from the companies themselves. Earnings reports.
Yes, the bottom-up view. It provides that granular detail. Will it confirm the macro story or maybe contradict it? That's where it gets interesting.
First up, Tuesday after the bell, FedEx, FDX.
Yep. Global logistics bellwether. Their results give you a real-time pulse on trade, business investment, and consumer demand globally.
So what are we watching for there? Besides the headline numbers, EPS $6.04, revenue $21.89 Bs.
Forward guidance is key, and specifically this kind of internal battle they have. The headwinds from tariffs versus their own cost-cutting program, the DRIVE initiative.
And if their outlook is pessimistic?
That would be a pretty significant risk-off signal for the broader market, yeah. Suggests things are slowing down globally.
All right, now Wednesday afternoon. This sounds like a big one. Micron Technology, MUM.
Oh, absolutely crucial. This is a major stress test for that whole AI-driven market narrative we've seen. Micron makes the memory chips essential for AI servers.
And the expectations are, wow, sky high.
Completely sky high. Forecasts are for a massive 156.4% jump in earnings per share compared to last year, revenue up almost 30%.
Okay, so what's the play here?
Oh, this sets up a fascinatingly asymmetric risk profile, and here's why. A strong report, beating estimates, raising guidance, that's kind of already expected. It's largely priced in.
So good news might not move the needle much.
It would validate the AI story, probably give tech a bit more lift, but maybe not explosive. However, any sign of weakness, whether it's pricing pressure, maybe demand outside of AI's flagging, or even just cautious guidance about the future, that could suggest the whole AI narrative has gotten overheated.
And the result?
Could be an immediate and possibly quite pronounced sell-off, not just in Micron, but in related names. NVIDIA, Supermicrocomputer, the whole semiconductor ETF, SOXX.
Wow, so it really highlights this sharp confrontation of ideas. Is the AI boom sustainable at this pace or not?
Exactly. Conviction gets tested right there.
Okay, then Thursday afternoon, we get Nike and KE. And the picture here looks very different.
Dramatically different. The outlook is expected to be, frankly, dismal. Forecasts are for earnings per share to just plummet down to $80.12 from 99 last year. Revenue down over 15%.
Ouch. What's going on there?
They're facing a bunch of headwinds. Tariffs are hurting them. They seem to have too much product out there. And analysts are describing their brand heat as lukewarm.
Lukewarm is not what you want for Nike.
Not at all. But the contrast here is what's really important. Between Micron's boom and Nike's gloom, this perfectly illustrates what people are calling a K-shaped economic reality.
The K-shape. Explain that.
Think of the letter K. One arm goes up, the other goes down. Micron represents that upward arm, high-growth, tech-driven, maybe somewhat insulated from broader economic woes, soaring on the AI trend.
And Nike.
Nike is the downward arm. It represents the traditional consumer-facing economy, the part that's getting squeezed by inflation, maybe geopolitical uncertainty, weaker consumer spending.
So this is a critical aha moment then for understanding the market right now.
Absolutely. If both companies report roughly as expected, Micron strong, Nike weak, it confirms that the current market rally is really being driven by a very narrow set of themes, mostly AI.
While the broader consumer economy might be stagnating or even shrinking.
Precisely. And that has huge implications for how you think about market trends overall and how you might want to position your own portfolio strategically.
That K-shaped insight really does make you think, doesn't it? It suggests you can't just paint the whole market with one brush anymore.
Not at all.
So what does that mean for someone trying to decide between, I don't know, a tech fund and maybe a consumer staples fund?
It means exactly that. Your analysis has to become much more targeted. It's less about predicting the overall market tide and more about understanding these specific currents within it. Which part of the K are you actually investing in?
Because the performance could diverge dramatically.
Hugely. It demands more specific strategies, not just writing an index.
Okay, let's talk about the Fed factor. Because their commentary, that's going to drive a lot of the day-to-day swings, isn't it?
Oh, absolutely. Fed official speaking will be a primary driver of intraday volatility. You really need to listen closely this week.
The main event here is Fed Chair Jerome Powell's testimony to Congress, right? Semi-annual thing.
Yep. He is before the House Financial Services Committee on Tuesday, then the Senate Banking Committee on Wednesday. His prepared remarks, the script, will probably just reiterate that data-dependent stance we talked about.
Standard stuff. But the real action.
The real action is always in the unscripted Q&A. That's where the sparks can fly.
He's going to get grilled.
Yeah.
Especially about why they aren't cutting rates, particularly with an election coming up.
No doubt about it. He has to walk this incredibly fine line. He needs to sound resolute, tough on inflation, to keep the Fed's credibility intact.
But he can't just dismiss the worries about a slowing economy either.
Exactly. So there's a risk he sounds too hawkish, too focused on inflation, which could spook the market into a sell-off. Or he could sound like he's bowing to political pressure, which damages the Fed's independence and credibility. It's a real tightrope walk.
And it's not just Powell, is it? There are a lot of other Fed speakers this week.
A deluge of them. It's an exceptionally busy schedule. Multiple governors, regional Fed presidents, they're all out there talking.
So what's the risk there? A mixed message.
That's the main risk, what we sometimes call policy cacophony. The base case is they stick to a unified message, but
the FOMC, the rate-setting committee, isn't a monolith. They don't all agree perfectly.
Precisely. They have differing views.
Yeah.
And subtle differences in tone, or maybe how they emphasize certain data points, those can get magnified like crazy by treating algorithms in a market that's already on edge.
So traders need to be ready for big swings during the day based on who's speaking when.
Absolutely. The biggest risk is probably someone saying something that seems to contradict Powell, even unintentionally. That just injects fresh uncertainty.
Okay, so putting this all together, the data, the earnings, the Fedspeak. It sounds like there are really two main paths the week could take.
Broadly speaking, yes. Synthesizing everything, two primary scenarios emerge. And they really hinge on that Fed messaging and ultimately Friday's PCE data.
Right. Scenario one, the positive one.
We call it the Goldilocks path. Not too hot, not too cold. This leads to a powerful risk-on rally. Investors feel good about taking risk.
What gets us there?
The catalysts would be gentle economic cooling. You see that in the PMIs. Maybe consumer confidence holds up okay. Powell's testimony goes well. He sounds confident. The other Fed speakers sound unified. Micron delivers a strong report.
And the big one?
And crucially, that core PCE number on Friday comes in at, or even better, below 2.5%. A clear signal that disinflation is back on track.
Okay, Goldilocks scenario. What's the market impact?
Significant rally. NASDAQ likely leads, powered by tech, as those lower rate hopes combine with strong AI fundamentals.
Other winners.
Rate-sensitive sectors like real estate, maybe more speculative tech stocks, they do really well. The broader S&P 500 moves higher, and even cyclical stocks, the ones tied to the economic cycle, join in on hopes of a soft landing. It's a clear, positive outlook, a green light.
Okay, but there's another path. Scenario 2, the less rosy one.
Right, the stagflationary fear path. This leads to a broad risk-off sell-off. Investors run for cover.
What triggers this?
It could be conflicting data, maybe signs of economic stagnation alongside still high prices, Powell sounding hawkish, or maybe the Fed speakers just sound confused, disjointed.
And the earnings.
Worse than expected reports from Nike or FedEx would definitely amplify recession fears. And then the final nail in the coffin. A hot core PCE reading, say 2.8% or even higher.
Yikes. Market impact there.
Deeply negative. Broad-based sell-off, NASDAQ and tech get hit particularly hard as those rate cut hopes just evaporate.
S&P 500.
Under significant pressure. Consumer discretionary, industrials, financials, likely selling off broadly. Your defensive sectors, utilities, staples might hold up relatively better, but it would still be a widespread market decline. It's a clear negative outlook, a strategic warning flag.
Okay, so boiling it all down. If you had to pick the single biggest risk and the single biggest opportunity this week, what are they?
The primary risk, hands down, is that core PCE report coming in hotter than expected on Friday.
Why is that the critical one?
Because it directly attacks the whole disinflation is happening narrative that's been supporting stock prices. It forces markets to reprice Fed policy hawkishly, pushes rate cuts way further out, maybe even off the table for a while.
And the impact is sharp.
Sharp rise in Treasury yields, significant broad equity correction, and real acute pain in those rate-sensitive growth and tech stocks that have led the market up.
Okay, that's the risk. What about the primary opportunity?
The opportunity lies in getting a decisive soft landing signal, a clear sign the economy is cooling enough to beat inflation, but not so much it crashes.
And what does that look like in terms of the data in Fed?
It looks like that cooler core PCE number 2.5% or below, combined with the successful Powell testimony. He needs to sound confident about controlling inflation without needing to crush the economy to do it. That's the sweet spot everyone's hoping for.
And if we get that?
That's a powerful green light for investors. It validates the Fed, palms those hawkish fears, and could really unleash capital back into risk assets. You could see a significant rally into the end of Q2, especially for the S&P 500 and the NASDAQ. That's the clear opportunity, the strategic plan for playing positive momentum.
And then lurking in the background, there's always the wild card, right? The stuff you can't schedule.
Geopolitics. Precisely. Unscheduled, but always potent.
What are we watching there? Middle East? China?
Both. Ongoing tensions in the Middle East are always a risk. A sudden escalation could spike oil prices, which feeds right back into inflation and makes the Fed's job way harder.
And U.S.-China trade?
Any negative developments there can quickly sour sentiment and directly hit global companies. Think Nike, think FedEx again. It remains this powerful, unscheduled risk that could just override everything else, no matter what the economic data says.
So as you can probably tell, this deep dive has really tried to clarify these opposing forces, the complex dynamics playing out this week.
Yeah, we hope we've equipped you with the knowledge, the framework to understand the market's moves, whichever path it ends up taking.
And maybe here's a final thought for you to ponder. Given this K-shaped economy we've talked about, some parts booming, like AI, others struggling, like maybe traditional retail. How might your own personal economic experience, what you're seeing day to day, align with or maybe diverge from that broader market narrative this week?
Yeah, how does this deep dive shift your perspective on what's really driving market trends right now? Because it's clearly not just one single unified story.
Definitely something to think about. Thanks for joining us for this deep dive.
Always a pleasure.
Make sure you subscribe to The Deep Dive wherever you get your podcasts. That way you get the fastest, most frequent updates and stay ahead of the curve on critical market insights and other complex topics we tackle.
We'll be back soon.
Yeah, we'll be back soon with another essential deep dive.